portfolio is a combination of different assets. Is a combination of different assets. A portfolio is a combination of what here? Of different assets. Yeah, it's a combination of different assets. Just a minute. So as an investor, it will be very, very important for you to combine different assets as you make your investments. You can't just be going for the same class of assets, Atoe kazi yako ni kununua tu mashamba, you just buying land. No. What if, for example, the land industry, one time like it is today, really doing very, very poorly? Where will you be getting your daily bread from? So in this case here, you have to do what you have to combine different assets whenever you want to form a very nice whenever you want to form a very nice portfolio. So a portfolio is a combination of different assets. Tell us there that investors form portfolios. Investors form portfolios for risk minimization purposes. For risk minimization purposes. Yeah, of course, the concept here is that you should never put all your eggs, don't put all your eggs in one basket. Don't put all your eggs in one basket. Don't put all your eggs in one basket. Should you do this? If, for example, you're going to the market with all your eggs in one basket and then you stumble on a rock like this and then you just go down, then you lose all your eggs. What if, for example, you have to spread your risk and have two baskets, right? So one basket with 15, another basket with 15. The basket will probably fall over or rather fall on. That one you're going to lose. This is a basket here. Some of them could be salvaged. So you should never put all your eggs in one basket. This is a mistake I've seen people doing. All right. You get in this case here, for example, somebody saying that I have to invest all my monies with government. All right. Of course, you're not saying that the government can easily go down and then it fails to pay back. But things happen. Look at, for example, what happened in Ghana. All right. Ghana, in this case, the government just could not pay. They defaulted. All right. So you're saying government bonds, government treasury bills, they're very, very good, but don't put all your eggs in one basket. I would want, in this case here, my students in here to always think about what here? Diversification. You diversify. Put a little here, a little there, and then at the end of the day, you shall do what here? You shall be able to really minimize your what here to minimize your risk. You shall be able to minimize your risk. Okay, so in terms of your exams, what are we required here to master in terms of your exams? So in terms of your exams, I would want us to look at our past papers right away to see what this examiner wants us to really be good at. Our examiner would want us to be good at getting returns, what we call expected returns. How do we get expected returns? How do we get standard deviations? How do we get, in this case here, covariances? How do we get coefficient of correlation? How do we get, in this case here, CPFM returns? APM, those are great things that the examiner would want us to know how to compute. Yeah, and I would want us to look at November 2019 question number 3. 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 Once you guys get this question, can you kindly tell me, hey, we already have this November 2019 question number 3. where the examiner in the required, he wants us to get expected return, coefficient of correlation, portfolio risk. Then we have 4, the reduction in risk due to portfolio what year? Diversification. Due to portfolio diversification. November 2019, question number 3. 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 Somebody can as well take a screenshot of this question and then they send it to our group. They send it to our group. Thank you, Ross. So we are told here Duncan Kipchumba has an investment capital over $1 million. He wishes to invest the funds in 2 securities, XY, in the following proportions: 200,000 in X, 800,000 in Y. The return on these 2 securities depend on the state of the economy as shown below. So you have state of the economy, probability, returns on X, returns on Y. All right, just a minute. Okay, so November 2019, question number 3. So, of course, you can see a situation where this gentleman has $1 million. He has invested 200,000 in X. He has invested 800,000 in Y. So basically, they want us to get the weights there. They want us to get the weights there. They want us to get the weights there. So how do we get these weights? So come and give us weights of X. So out of $1 million, he has taken 200,000 to X. Out of $1 million, he has taken 200,000 to X. That's a weight of 0.2. He has taken, in this case here, 800,000 to Y. Out of $1 million. Out of $1 million. This gives me 0.8 here, 0.8. So up to there, ladies and gentlemen, are you guys able to follow? Because you see, he had $1 million. And out of this $1 million, 200,000 went to X, 800,000 went to Y. Are we together? Are we together? How I've gotten those weights? Weights are basically the proportions, right? The proportions. So then you can see the returns on these 2 securities depend on the state of the economy as shown below. So you can see the state of the economy, the probability returns on X, we have returns on Y. So they want us to give them the expected return on the portfolio. Expected return on the portfolio. So then to get expected return on the portfolio, first, ascertain expected returns, of securities, So we shall first get expected like this, expected returns of X. You can write this in full. This is expected returns of X. How do we get expected returns of X? It's very easy. You will take returns of X given, the actual returns of X given, times their corresponding probabilities. And then you do what here? You sum like that. So you take the actual returns of X times their corresponding probabilities, and then you sum. This is basically the concept of theta 1 plus theta, like that. What do you mean with this concept of theta? If you look at it, ladies and gentlemen, they have given us, for example, actual returns of X. You can see they have given us actual returns of X. That I would rather take this as percentage up there. They have given me returns of X 18. We have 14. Then we have 12. And then I can see the probabilities given. So I can see this is 0.4. I can see this is 0.5. I can see this is 0.1. So theta, this is the actual return times its corresponding probability. Theta plus theta plus theta. And then you're able to get, in this case here, the expected returns of what year? Expected returns of X. So to be able to get these expected returns of X, what do I do? To get expected returns of X, I'm using the concept of, so 18 times 0.4 plus, we have here 14 times 0.5 plus, we have here in this case here 12 times 0.1. 12 times 0.1. Are you able to give me this answer? Expected return of X. Are you able to give me this answer? Yeah, let's do this. Don't worry. Let's do this. You guys have the LMS and other things. We must diversify also our risks. We can't die with one topic throughout. We can't die with one topic throughout. That's the mistake I've always seen people doing. You die with topic number one throughout and no question comes from there. Let's diversify. That's what I'm teaching today. Portfolio, risk diversification. 15 point what year? 15.4. Thank you very much. So from there we have expected returns of Y. So expected returns of Y, what do we have there? You see, probabilities are the same. Probabilities are the same. So now we are simply taking the actual returns of Y times this. So we have 24. So 24 times 0.4 plus we have here 22 times 0.5 plus we have here 21 times 0.21 times 0.1 like that. What are we getting, ladies and gentlemen, here? 22.7. Thank you so much. 22.7. So up to here, ladies and gentlemen, of course, those figures are the percentages. Up to here, have you been able to follow? Have you guys been able to follow up to here? What you have done to get this? Have you been able to follow abracadabra? Yes. So then that is number one. And you see this number one, they never wanted us to just get expected returns of securities. This is the first step. Here they want us to give them expected return of the portfolio. They want us to give them expected return of the portfolio. How do we get expected return of the portfolio? To get expected return of the portfolio, you have to write this in full at first. You write expected return of the portfolio. You see, a portfolio is a combination of different assets. Like now we're combining X and Y. So to be able to get this expected return of the portfolio, this is really easy. Why? Because we have taken in this case here X, right? And then in this case, we combined this with what here? With Y. But now remember, it has to be proportionately. So this has to be weight of X, expected return of X, plus weight of Y, expected returns of Y. Because you see, a portfolio is a combination of different assets, is a combination of different assets. All right. So the weights already, we had obtained the weights. This was 0.2 times expected return of X, which is 15.4, plus we have here, ladies and gentlemen, 0.8 times the expected return of this, which is 22.7, like that. So now you're able to give me this expected return of the portfolio. Expected return of the portfolio will be equal to, yeah, according to Ross, 21.2. 21.2. So that is what we shall be doing, ladies and gentlemen, to get expected return of the portfolio. To get expected return of the portfolio. That is what we shall be doing. And with your permission, then I'll be able to go to Roman 2 of this question, where they want me to give them the correlation coefficient between securities X and Y. So they want me to give them the correlation coefficient. So number 2, they want me to give them the correlation coefficient between X and Y, between X and Y. So here again, first ascertain covariance. First ascertain covariance between X and Y. Between X and Y. So you first ascertain covariance between X and Y. What is covariance? Covariance is a shared variance. Covariance is the shared or the common variance, the shared. Whenever you hear of this word co, especially when you are a lady, and then you're passing somewhere, and then you hear somebody saying, "That is my co-wife." Please run, run, run. Co-wife means shared. You are sharing a husband with somebody. So the same case here, whenever you hear of covariance, it means what here? The shared variance. And if it is the shared variance, then how do we calculate this shared variance? We shall be using this short form for covariance. So covariance between X and Y, what we shall do is to take the deviation of X times the deviation of Y times corresponding probabilities, and then you sum. So anytime they want us to give them the covariance between X and Y, covariance, because now there are two beautiful ladies there in this mix. So you take the deviation of X multiplied by deviation of Y multiplied by probability. So deviation of X means what? Deviation of X. For deviation of X, ladies and gentlemen, we are taking the actual returns of X minus expected. You know, deviation means subtraction. Actual returns of X minus expected returns of X. Come and multiply this with deviation of Y, which is RY, minus expected returns of Y, times, in this case here, probabilities, times probabilities like that, times probabilities. And then, of course, there is what here? There is a summation like that. So this is how we get covariance between X and Y. Covariance between X and Y. Now, ladies and gentlemen, allow me to repeat this concept right away. Yeah. So anytime they tell us, ladies and gentlemen, to ascertain covariance between X and Y, covariance between X and Y, covariance between, I will take the deviation of X here, which is actual returns of X minus expected returns of, it can't be Rx minus ERY, no. So it is Rx minus ERX into the deviation of Y, which will be RY minus ERY. And then we multiply outside here with probabilities, and then outside here, we shall always come and something. Now, ladies and gentlemen, is there somebody who can see the actual returns of X? These are the ones given in the past paper. Expected returns of X, we had obtained this up there. So the actual returns of X, these are the ones given in the past paper. You can see there are only three. We have 18. I'm placing my figures in percentages. We have 18, 14, and 12. So 18, 14, and 12, minus. Those three, they are the actual ones, 18, 14, and 12. Expected return of X is the mean return. The mean return, already we got it up there. And if I remember very well, it was 15.4. What do you know about averages? 15.4, that average will not keep on dancing, will not keep on changing. So the 15.4 will be constant. 15.4, 15.4, 15.4, like that. We come and take the actual returns of Y. They're given in the past paper, actual, the second column, actual returns of Y. You read them the way they are, 24, 22, 21. 24, 22, 21, minus. And then we have expected returns of which I can't remember. We had obtained expected returns up there. Up there, we got expected returns, 22.7. So we have here 22.7, 22.7, 22.7, like that. And then probabilities probabilities are the same ones that you're using constantly. The probabilities are the same ones you're using constantly. The first column here, 0.4. So we have 0.4 there, we have 0.5 here, and then we have 0.1 there. Then you take your calculator, So this calculator, you say on, it's quite early in the morning, you can easily get a student who is using a calculator which is off. So you say on, open brackets, you say 18 minus 15.4, you close, times, open, 24, minus 22.7 close times 0.4. You say equals. Ladies and gentlemen, I'm getting 1.352. Is there somebody who is able to get 1.352? Thank you so much, Edna. Yeah, Pauline, great. So we go to the second one. Remember, everybody must punch these calculators. Everybody must punch these calculators. Everybody must get into what we call active learning. It's called active learning. If you're passively learning, that we shall be finishing our AFM syllabus and classes without you ever giving us a value. You're always just passive there, waiting for other students to give answers. You're not giving any trust in me. It will be disastrous in your exam. It will be disastrous in your exam. You must always participate. You must always participate. You must always participate here. 0.578. The third one is 0.578. So all of us are, let's confirm the third one. We confirm the third one. So the third one is 12 minus 15.4 close times open 21 minus 22.7 close times 0.1 equals. So I'm getting here 0.58. Right. Thank you so much. Thank you so much. And then you can see this is not expected. This is sigma for summation. Summation. So you come and sum, ladies and gentlemen, here, and they give me the covariance. Give me the covariance between X and Y. Between X and Y. So you give us the sum. You give us the sum. So according to Audrey, we are getting 2.42. 2.42. We are getting 2.42. 2.42, Pauline has confirmed. Thank you so much. So that is the first thing that you do. The second thing that you shall be doing is called the standard. So you ascertain the standard deviation of the securities. Number two, ascertain the standard deviations of what year? Of securities. Ascertain the standard deviations of securities. Ascertain the standard deviations of securities. So we shall start with standard deviation of X. So standard deviation of X, you write like that. Standard deviation of X, you write like this. Standard deviation of X, you write like this. So professionally, how do we write standard deviation professionally? You write a 0 and then you pull a tail, a small tail. You'll get other students in this case here writing standard deviation like this is not professional, this is unprofessional, this is mitochondrial. For us, standard deviation, ladies and gentlemen, you write a 0, a small one, and you pull a small tail. And then you come and tell us standard deviation of X. So still it's deviation of X. How do we get deviation of X? It's very easy. You will come and take Rx minus ERX. Because that's deviation means subtraction. Actual returns minus expected returns. These are special deviation. This must be in terms of sum of squares. First of all, before you talk of sum of squares, this is how I look at them. Very, very important. It's deviation. Deviation means what, ladies and gentlemen? Difference between two returns. Actual returns given in the past paper minus expected returns. These returns must always be done what year? Squared. There are many of them, probabilities. Each one of them you must multiply outside the probability. And because there are many of them, you come and sum. It can't be standard deviation without a square root. It can't be standard deviation without what year? Without a square root. It can't be standard deviation without a square root. It can't be standard deviation without a square root. So populate this. Population means you start with actual returns. Actual returns, we are picking the ones in the past papers. The ones in the past papers, we have 18, 14, and 12. Those are the actual returns. Expected returns, we found expected returns in part 1 of the question. it was 15.4. Expected return will not keep on fluctuating. Regardless of the state of the economy, expected return will always remain the same. Probabilities, we have them. They shall be used constantly. 0.4, 0.5, 0.1. This root will come after we have summed the three. Don't get root for each one of them. You see the root, we have summation first. So after we get each one of them individually, we sum them, and then we get the square root. And then we get the square root. And then we get the square root. Minus, plus, squared, times 0.4. So what are we getting, ladies and gentlemen, here? The first one. What are we getting for the first one? 2.704. 2.704. The first one. As you say, open brackets, 18 minus 15.4 squared times 0.4. Give me an answer. Aha, we go to the second one. We go to the second one, 0.98. So we have here 0.98. We go to the third one. Third one, open brackets, 12 minus 15.4. You square times 0.1. 1.156. 1.156. And then you can see this summation now. These ones here, all of them to be summed first. So you come and sum the three. 4.84. 4.84. 4.84. So what is the special name for this that you have just gotten when you add? You've gotten what we call variance. Variance. And the standard deviation is the square root of the variance. So I should come here and say square root of 4.84. Square root of 4.84. Square root of 4.84. Then that will give us what figure at the end of the day? 2.2. So this gives us 2.2 like that. So I don't know whether up to here you guys are able to follow. Up to here, have you been able to follow what Mwalimu is doing? All right. And please ensure that you use your calculator. You're using your calculator, you're giving us answers. And most importantly, remember that I'm your ninja. You must always ask your ninja questions without fearing. So then from there, ladies and gentlemen, I would want us straight away to look at the standard deviation of y. Come and give me the standard deviation of y. Is there somebody who thinks they can write the standard deviation of y formula by themselves? Just try. Just try. Don't try to copy from this. No, I want you to write it from really. He's asking there that whether negative aren't taken into consideration. Good question. But remember, if, for example, you're given here, say 3 minus 4 squared, right? You see, negative squared, negative will always disappear. You know, this one here will be minus 1 squared, which will be the same as saying minus 1 times minus 1, which will be the same as what here? Positive 1. There is no way you will ever get a squared number being negative. No way. No way you'll ever get a negative number being, and I know normally when you see, like, you should never use like your calculator this way. You should never use your calculator this way. You should never. That's why you see I'm insisting on brackets. If you come and say 3 minus 4, then you say equals, and then you say squared, you say equals. You can see in this case here, most calculators will simply give you a negative answer. Most calculators. That is why, however simple it is, what I normally tell my students, if it's a square, just put everything in brackets. 3 minus 4, close bracket. And then you say squared. The calculator is so much disciplined to follow brackets, to follow bodies. All right. So, ladies and gentlemen, to be able to get standard deviation of y, this is normally what we do. It is deviation of y. So it will be actual return of y minus expected return of y squared times probability. Then there must be some, and then I pull the square root like that. If you give this to me, then I'll be able to give you, ladies and gentlemen, are y, actual returns of y. So the actual returns of y, what do we have here? Actual returns of y, I can see them there. We have 24. We have 22. We have 21, minus, minus, minus. The only thing I've forgotten is what we got up there as expected return of y. That one I have forgotten. Expected return of y. We got a figure 22.7. So this expected return of y, this will remain. This will remain. This will remain constant. Probabilities, I can pick them. I can pick the probabilities. Probabilities, I can pick them. Probabilities, I can pick them. So we have here 0.4, 0.5, 0.4, 0.5, 0.1. These ones I can pick them. These ones I can pick them. So like this is where I will do it in my calculator. I'll come and say, you can say 24 minus 22, squared, sorry. Squared. No. You simply say open brackets 24 minus 22.7. Then you square times 0.4. You get equals 0.676. Like that. Now I've set an example for you. Now you should be able 0.245. 0.245. So we have here 0.245. And then lastly, what do we have here? Lastly, what do we have here? Lastly, already Claro has standard deviation 0.289. Then what is this variance when you come and add? So you come and add everything. You come and add everything. Therefore, standard deviation will be the square root of that 1.21, and the Caro has already gotten 1.1. Caro has already gotten 1.1, like that. Thank you so much. Now, gentlemen, from there, then I will be able to proceed if you guys don't have any question for this ninja, for this CPA chief ninja. This CPA chief ninja. What I will do, I will go straight away now to correlations. Remember the question was asking us about correlation coefficient. So now they want us to give them the correlation coefficient between X and Y, R between X and Y, R between X and Y. How do we get this R between X and Y? So to get R between X and Y, it's very easy. You will take the covariance between X and Y divided by the respective standard deviations. So anytime they tell us to give them coefficient of correlation, it shall be the standardized covariance. The covariance divided by the respective standard deviations. So correlation coefficient is the standardized covariance. So are you guys able to remind Mwalimu what we got for our covariance between X and Y? Is there anybody who is able to remind Mwalimu what we got for our covariance? What we got for our covariance? Yeah, 2.42. Divided by the standard deviation of X. I know standard deviation of Y is 2.2. How about the standard deviation of X? No. This is what was, this is X. 2.2 is X. 2.2 is X. How about standard deviation of Y? How about standard deviation of Y? How about standard deviation of Y? It's 1.2. It's 1.2. So then this gives us exactly 1, if I'm not wrong. The correlation here is exactly 1. The correlation is exactly there, 1. The correlation is exactly 1. The correlation is exactly 1. It's exactly 1. So then, gentlemen, this basically would mean, what would this really mean? This one would mean that when this R, X, and Y is exactly 1, this is 100%. It means that X and Y are perfectly, they are perfectly, positively related. Perfect because of 100%. Positive because the number is positive itself. So whenever you hear that two securities have got a perfect positive relationship, it means that the R is 1 or 100%. Perfect negative relationship, it means that R is minus 1. Tell us there that this means that X and Y are mirror images. They are mirror images of each other, i.e. they are not different. They are not different. They are not different. They are not different. Because the relationship is perfect. They are Siamese twins. They are not different. What does that mean, ladies and gentlemen? They cannot make a good combination for a portfolio here. They can't. They cannot make a good portfolio. Don't combine those two to make your portfolio. Remember when we began, we said that a portfolio is a combination of what here? Different assets. So if you get X and Y having exactly a perfect positive relationship, those ones are not the very best. Those ones are not the very best. Because what would that mean? It means that as the share price of X is up there, going up there, also the one of Y is up there. When again they fall both at the same time. So you'll not be diversifying any risk. Ladies and gentlemen, even in our general relationships, let me tell you, if you get your marriage being like perfect, where you're walking all over, you're holding hands, etc., perfect. Trust you me, there is a big problem. There is a very, very big problem. There's a very, very big problem. It doesn't work out like that. Lazima kuwe na dosari. So there is either a very big problem or one of you is irrelevant. And also one of you in marriage can be relevant. Yeah, we should never have in this case a situation where you agree about everything 100%. One of you will be irrelevant. One of you will be relevant. You guys, you should start paying me for giving you also kind of different advices as we study. But now that one, somebody may say it's a bad advice. It's a bad advice. When you reach my age, you'll know what I'm talking about. Hata kuna mali nisoma mwingine akisema ati hao watawachana tu. Sababu yashajua portfolio management. We need in this case here to disagree, not all the time, but we should be disagreeing somehow. Somehow. So ukiona mna disagree kidogo na mzee, hiyo ni kawaida sana. That's very healthy. That's very, very healthy. Trust you me. That's very, very healthy. Yeah, we should be ninjas, yes. But please, if you are here and you are the type that holds their, wives again, out there all over proudly, usikasema mwalimu ni mbaya, hapana. Hiyo ni kipawa, kuna kipawa aina yake, which is still okay. Usikasema kusema mwalimu anatudanganya, hapana, kuna kipawa aina yake. Very good. So, ladies and gentlemen, perfect securities for portfolio are perfectly negatively related. Perfect securities for portfolio formation are perfectly negatively related. So whenever you want to form a portfolio, ladies and gentlemen, then you should be able to look at it this way. Your R between X and Y, if possible, should be -1. When one security is doing very well up there, the other security in this case is doing very, very badly. And then they keep on changing. When this one is up there, the other one is doing very, very badly. Although now this one cannot work in a marriage setup again. Yeah, in marriage setup, it can't be like two extremes again. No. But for portfolio formation, this extreme is what we want, but in the negative relationship. In the negative relationship. Yeah, yeah. Because you'll be told in this case here to advise. When it is positively, perfectly related, that one you shall reject. But if it's a negative, perfect relationship, that one we shall accept. That is what here, very good. That is what here, very good. That's very good. That's very good. So up to here, ladies and gentlemen, are we together? Up to here, are we together somehow? Up to here, are we together somehow? Are we together somehow? All right. Thank you very much. So now we are through with number 2. In number 2, the things that I've sold to you here, which are very, very important for you. Number 1 is how do we get covariance between two deviations here? So we have deviation of X, deviation of Y times probabilities. You sum. I've sold you the idea of what your standard deviation of X, Rx minus ERX squared probability, sum square root, like that. I've sold it to you the idea of R between X and Y, where you take the covariance between X and Y divided by the respective what year standard deviations, divided by the respective standard deviations. Very, very important that you get to read or rather watch this video, not tomorrow, but today. Not tomorrow, but today. Not tomorrow, but today. And then, ladies and gentlemen, you can see here they want us to do something very, very important here. Now they want us to do what here? To come and give them, look at Roman 3. So Roman 3, what do they want us to give them? So Roman 3, they want us to give them the portfolio risk. They want us to give them the portfolio risk. They want us to give them the portfolio risk. So risk is normally measured using standard deviation. Whenever you hear the examiner talking of portfolio risk, they want you to give them standard deviation of the portfolio. 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 And this standard deviation of the portfolio, how do I get it? I know that a portfolio, I'm combining like now two standard deviations here. Two standard deviations here. But now remember, it has to be what here? It has to be weighted. So we have here weight X, weight Y here, like that. The two of each one of them, each of these must be squared. Plus twice covariance between XY, weight X, weight Y, like that. And then you come and put, an ugly formula, but the other day I read a book like, for you to succeed in life, you must know how to eat frogs in the morning. You must know how to eat frogs very early in the morning. Those duties that you hate most are the duties you should start with. Yeah. Or if you go to a team and then everybody is saying that I don't want to do this, I don't want to do this. Those things that others are refusing to do them. You really succeed in life. So like now there must be somebody who is already hating this formula. So as you hate the formula, I like it. To get standard deviation of the portfolio, we shall be taking weight of X squared, standard deviation of X squared, plus weight of Y squared, standard deviation of Y squared, plus twice covariance between XY, standard deviation X, not standard deviation, covariance XY, WX, and then we have WY like that. So fortunately, we have everything, ladies and gentlemen, here. We have everything, ladies and gentlemen, here. We know that this standard deviation of the portfolio will be equal to, is there somebody who can still remind us the weight of X? Anybody who is able to remind us the weight of X? Yeah, 0.2. 0.2 times 2.2. 0.8 times 1.1. Each one of them must be, don't forget the squares. Because standard deviation of X, I can remember it was 2.2. Weight of Y was 0.8. Standard deviation of Y was 1. Plus, ladies and gentlemen, twice, covariance was 2.42, if I'm not wrong, 2.42. 2.42. And times 0.2 times 0.8. Please confirm this to me. The covariance between X and Y. Was it 2.42? The covariance between X and yes. Yes. Thank you so much. So then now what we shall do is to pick our calculator then. So you pick our calculator. So our calculator, we say here, don't start with square root. You say 0.2 squared. 0.2 squared times 2.2 squared plus 0.8 squared times 1.1 squared plus 2 times 2.42 times 0.2 times 0.8. You say equals. So whatever answer you get, you say square root. Whatever answer you get, you say square root. Whatever answer you get, you say square root. Yeah, yeah. Is there somebody who is able to get that 1.32? Anybody who is able to get 1.32? Anybody who is able to get 1.32? I've gotten 1.32. Rose has gotten 1.32. Carol has gotten 1.32. Thank you so much. 1.32. So that is how we get, in this case here, the standard deviation of a portfolio. Standard deviation of a portfolio. It looks like a big thing. It looks like a big thing. But when you sit down later and rewatch this video very well, and then you take time in this case here to memorize. Ladies and gentlemen, you know you must also know good skills of learning. Good skills of learning, like when you are taught this kind of a thing, number one, you can't master everything like 100%. Even if you're giving me answers, I don't think that you've mastered 100%. You must always get into that situation where you do reflection. You must sit somewhere, like now today over lunch hour. You can use your lunch hour optimally. And in this case, you ask yourself a question. What did we study today in the morning? We studied portfolio management. Am I able to remember those things that we studied? Then take even a blank paper, try to write down those formulas, all of them. And then those things, of course, will now enter into your memories permanently. Even when you are sleeping, I mean, I do this myself every other day, right? I simply, in this case here, try to remember what I've done during the day. I try to recall. At times, in this case, it'll even get me waking up at times because I'm not able to recall everything that I learned. Yeah, to go and now make reference. That way you'll be able to really know these things. But if you're watching this like round one, and then you wait, in this case, to revise when your exams are like tomorrow, the formulas will become too many for you. The formulas will become too many for you. So that concept of reflection is very, very important. So that is standard deviation of the portfolio. Now, ladies and gentlemen, from there, we shall go to number 4, the last one, the reduction in risk due to portfolio diversification. So, percentage of risk reduction, percentage of risk reduction, percentage of risk reduction, percentage of risk reduction. So to get this percentage of risk reduction, we normally take the weighted standard deviation of the portfolio minus actual standard deviation of the portfolio. Weighted the standard deviation of the portfolio minus the actual standard deviation of the portfolio all over the weighted standard deviation of the portfolio. All over the weighted standard deviation of the portfolio. So this is a weighted standard deviation of the portfolio, weighted standard deviation of portfolio, weighted standard deviation of portfolio, and then we have here actual standard deviation of the portfolio. So actual standard deviation of the portfolio, very, very important. So already we have the actual, these already we have. The actual standard deviation of the portfolio, we've gotten 1 point what here? The one we got up there is the real one, is the actual. Is the actual. So whenever you're asked to get the standard deviation of the portfolio, you should be computing the actual. You shall be computing the actual, right? And then now we have to compute the weighted standard deviation of the portfolio. So how do we get this weighted standard deviation of the portfolio? To get the weighted standard deviation of the portfolio is very easy. This is really, really easy. How do we get weighted standard deviation of the portfolio? It's very easy. We take weight X, standard deviation X, plus weight Y, standard deviation Y, like that. So weight X is 0.2. Standard deviation Y, you guys, or rather X, you guys have given me the figure, it was 2.2. Plus, in this case here, weight Y. Weight Y, if I remember very well, this was 0.8 times standard deviation Y. Standard deviation Y, this was 1.1, yes, like that. So now you're able to give me this weighted standard deviation of the portfolio. The weighted standard deviation of the portfolio. Please give me answers. Give me answers. Phasor 1.32. Phasor 1.32. Thank you very much. So, oh yeah, kuja hapa subtract. The weighted standard deviation of the portfolio 1.32 minus actual standard deviation of the portfolio 1.32. All over weighted 1.32. Aki umereduce 0%. Umereduce 0%. Uja reduce chochote. How would you reduce chochote in terms of what? Yeah, in terms of risk. How would you reduce chochote in terms of risk? And that is why even in family setup, as much as we should really do like what we call family businesses, I will be very hesitant in this case here, for example, to run RCM with my wife. No, my wife is veterinary doctor. Wataenda kuwe na ito namna gani? Shops zake kule, atibu ng'ombe namna hii, namna hii, namna hii. Of course, atakuwa na shares RCM. That is to diversify risk for the family. Just in case, for example, we have come all of us to RCM and then Mwalimu Aura unfortunately dies. I mean, the entire family can get into depression. We should always endeavor to diversify. We must always endeavor to diversify in everything that we are doing. That is a topic that I'm teaching you today. It's called portfolio management. Ama nyinyi mnaamini na mambo ya specialization? Is there any ninja here who believes in just specialization? Kwamba specialize as a family. Tunaingia kwa construction wote. Tukiingia kwa construction industry wote, tunajenga manyumba ya county government. County government zinakosa kutulipa. Marriage inavunjika hapo mbele. Marriage inavunjika hapo mbele. We must diversify. Wacha mzee afanye vitu zake kule na mama pia afanye namna gani vitu zake kule. Yeah, inasaidia sana. Hata mtoto akimaliza namna hii, jaribu kuangalia pia waende vitu tofauti. At the end of the day, you will win. But if we are putting all our heads in this case into one thing, of course, you'll be seen to be flourishing initially. But when things up there, when the center in this case here breaks, when the center falls apart, automatically every other thing will fall apart. Never put all your eggs in one basket. Never put all your eggs in one basket. That will be very, very dangerous. That will be very, very dangerous. Never put all your eggs in one basket. One basket. Yeah, Indians for some reason, they manage. Yes, I agree. Indians for some reason, they manage. For some reasons, they manage. You know, their model of even dispute resolution is really, really very kind of religious based and very, very strong. Wakikosana inakuwa rahisi. Lakini yetu, kama nilikuwa Windisa juzi, Windisa ile ilikuwa michuki hoteli mzuri na ng'ara. Yani imeanza kuchakana. Nauliza shida nini? Watoto hawaelewani. And really the wealth which is there is too much. Everybody should be able to get, in this case here, I mean, enough. The cake is too big. If we were Indians, ideally, like for example, like now my children, if we were Indians, then I would want them to really do this CPA and anything. But now because you're not Indians, I would rather they do very different things. Valosi, eh? We shall overcome. We shall overcome. Now, ladies and gentlemen, that takes me to what we call CPFM. 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 So now next topic, subtopic I mean, is CPFM. CPFM stands for Capital Assets Pricing Model. 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 Now, ladies and gentlemen, remember, CPFM assumes that investors are risk averse. CPFM assumes that investors are risk averse. Investors are who? Risk averse. Risk averse. So whenever they are coming up, in this case here with their investment strategies, they always mix risk and risky assets, i.e. they mix, risk-free with risky assets to ascertain neutrality, to ascertain neutrality like that. They mix risk-free with risky assets to ascertain neutrality because waoga sana. And that is why we normally say CPFM returns equals risk-free plus ERM minus risk-free multiplied by BS. Andika namna hiyo. CPFM returns equals risk-free plus ERM minus risk-free multiplied by BS. We have done this somewhere. Remember, our F stands for risk-free. This stands for risk-free, rate of return. We have ERM. ERM stands for expected market returns, And then we have here BS standing for beta of a security. Beta of a security. Remember, we were calculating what we called CPFM cost of equity. We remember some time back, CPFM cost of equity. So here we're using beta equity. But now here we shall be using beta of a security. Beta of a security. And then if you can remember very well, beta is a measure of systematic risk. Beta is a measure of systematic what here? Risk. Beta is a measure of systematic risk. Beta is a measure of systematic risk. Have you guys written this? And have you guys been able to highlight this? Have you guys been able to highlight this? Thank you so much. So to end straight away for December 2021, question number 2A. 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 And then I would want to make a proposal. You know, now this weekend marks exactly the middle of our semester, this weekend. This weekend marks exactly the middle of our semester. So I would want this weekend to do marathon classes for advanced financial management to clear the syllabus. And how do I do them? Twice. So Saturday, I will run Saturday a class from 7 a.m., not 7, 8 a.m. to 1. The same content, I repeat it on Sunday, 8 a.m. to 1. So that you guys can get a chance of being in either. Or Saturday, some guys will tell me they are working in your problem, But you see now you can fit into the one of Sunday. So Sunday we go to very early morning church. SDA guys in this case here to come on Sunday. So that I can get in this case here a chance of pushing like 2 topics complete. Ndio saa kutoka hapo tuanze kuslow down. So, and of course, if you're not able to make it, which will be very, very unfortunate, now you can rely on the videos. You can rely on the videos. Yeah, to me, it's normally like a push the syllabus weekend. Push the syllabus weekend. Yeah, so Pataki will come for Sunday. Yeah, you know, I'm doing the same content. I'm doing the same content for about 6 hours. Same content for about 6 hours. So you choose the one that you want. Is there anybody for some reason they can't be in either of the days? You can't fit in anybody for some good reasons. People could be having some good reason. You can't be on Saturday. You can't be in on Saturday. You can't be in on Sunday. All right. I'm happy to see that. Yeah, Saturday, good. I'm happy to see that guys will be available. Time, it's 8. It's 8 to exactly 1. It is 8 to 1. It's going to be a marathon weekend for you. 8 to 1. On Sunday, also the same, 8 to 1. It's going to be a marathon event for you, especially for those of you who have got afternoon classes. Mtakuwa na shida ya mgongo. Mtakuwa na shida ya mgongo sana hiyo weekend. Or the boss has taken advantage of the holiday. So Steve, partly Sunday. You know, Joy, I'm not going to disrupt any class. All your classes will continue as usual. Because you see, if we say we don't have a early morning class at 5 on that Sunday, why should I then give you a class on Sunday at 8? The Sunday 8 class is extra class to push things. So everything else is remaining normal. We have breaks. Yes, so many breaks and so many stories. So many breaks and so many stories. So many breaks and so many stories in between. So December 2021, question number 2. December 2021, question number 2. December 2021, question number 2A. Imelda na Simiyu. December 2021, question number 2A. December 2021, question number 2A. Imelda na Simiyu. December 2021, question number 2A. Once you get the question, kindly do your thumbs up like this. Thank you so much. So you're told Imelda Nasimiu holds the following portfolio of 4 risky assets and a deposit. Thank you very much, Rose. And a deposit in a risk-free asset. You see, this automatically is CPFM. The overall return on the market portfolio is 11%. So they want me to determine the assets that are inefficient, efficient, or super efficient using CPFM. Highlight 4 weaknesses of using CPFM in A1 above. We shall start with Roman 1. So they want me, first of all, what I will do there is to give them what we call the CPFM returns. Very easy. CPFM returns. That is the first thing we shall do. So CPFM returns equals risk-free plus ERM minus risk-free multiplied by beta of the security. This is risk-free. In this question, over 80% of the students were not able to give us this risk-free. Over 80% of the students here were not able to give us the risk-free rate of return. Because in most questions, it's normally given directly. In this question, if you were in this sitting, you see they have given us an asset called risk-free asset. They've given us an asset called risk-free asset. Are you able to see that its current return is 5%? Down there in that table, there is a risk-free asset whose current return is 5%. So shall just use 5 because in portfolio, we don't like working with percentages. Shall just use 5. So do we know the expected returns of the market from the question? Expected returns of the market, they have told us before required. There is a paragraph saying the overall return on the market portfolio of risky assets is 11. 11. ERM is 11. Haya, tuanze kazi. So sasa tuanze na CPFM returns of the first security called A. First security called A, for A. For A. So for A, so the risk-free here is 5 plus ERM is 5. No, ERM is 11. ERM is 11 minus RF. RF, which is 5, multiplied by BS. BS, we have a beta of A. The examiner has given us beta of A. In this table, the first beta there is beta of A, which is 1.5. Mimi najua 80% of the students again, wanga wanapata wrong hapa. Wrong hapa. Utaona mwanafunzi amesema CPFM returns ya A, ile market returns ya A, utaona amechukua ile 12 iko pale ya A. The market portfolio is only one. And it's a benchmark portfolio for all the others. It's a benchmark portfolio for all the others. So hiyo zikaenda change. You ushachukua ERM, even if you're getting B, itabaki the same 11 throughout. Those other current returns given there for individual securities will be used for evaluation of efficiency. So somebody already is giving me an answer here for CPFM returns of A. CPFM returns of A, what do we have there? CPFM returns of A, what do we have here? Somebody is giving me 14. Please use your calculator very well. Everybody must use their calculator very well. So we have here 5 plus, open brackets, 11 minus 5 times 1.5 equals, we're getting 14. And then we have B. So B, we have 5 plus. You see, the risk-free is the same throughout. Even these market returns are the same throughout. So 11, what will keep on changing in CPFM is the risk profile, is the risk factor. So like now here for B, I will take what here for B, if you're following beta for B. Beta for B, already they have the answer. These guys, I'm asking them to give me. So already they have the answer. These guys are geniuses. They're telling me, Mwalimu, this 17. This 17. And then you go in this case here for C. You can see the risk-free is the same. The risk-free is the same. The risk-free is the same, 11 minus 5 times beta for cow. Beta for cow, you can see it is 1.2. Beta for cow is 1.2. So you come here, so we have here 5. Please, all of us, let's use, I know students here don't know how to use their calculator. Some of the reasons which make these guys here fail, or they don't practice. When mwalimu is teaching, they don't practice. Yeye anachukua figures zake tu. Anachukua figures zetu, yani 12.2. Anachukua figures zetu, anakopi alafu anasema mimi nimejua AFM. Hujajua kwa kutumia calculator yako. Sasa ukija hapa kwa dog, tuko na 5, itabaki the same risk free plus ERM 11 minus 5 times, in this case here D, beta ya D ni 0.9 actually. Yeah. Hii imewapatia ngapi somebody ya dog? The final answer is 10. Alafu wengi walisahau kutafuta hii ya risk free asset. Please write in full. I'm always used to writing it like this. Risk free asset. Ya risk free asset. So CPFM ya risk free asset, hii itakuwa ni 5 plus 11 minus 5. I know its risk is beta is 0. It's given there. Beta is 0. It's given there. So then this will end up giving me who? This will end up giving me 5. Are we together, ladies and gentlemen? Up to here, are we really together? Great. Then now once you've gotten the CPFM returns, now you need to come and give us what we call efficiency analysis. So you do what we call efficiency analysis. You come and do what we call efficiency analysis. Efficiency analysis. Efficiency analysis. So with this efficiency analysis, we normally use the Jensen's alpha value. Jensen's alpha value. The Jensen's alpha value. What we shall be abbreviating as this Jensen's alpha value. And to get this Jensen's alpha value, we normally take expected or actual. Expected returns minus CPFM returns. Expected returns minus, you can as well use actual. Like in this question, they gave us current returns. So you can come and use here current returns minus CPFM returns. Current returns minus CPFM returns. So you start with A, the alpha value for A. Is there somebody who is able to see the current return of A? Current return of A. Are you able to see the current return of A? Current return of A? 12, isn't it? So you can see the current return of A is 12 minus the CPFM return of A. Was it 14? CPFM return of A, 14. CPFM return of A, 14. So then what is 12 minus 14? 12 minus 14, this gives me -2. It's loss making. If it's loss making, it is an inefficient security. It's inefficient. It's inefficient security. It's inefficient security. Inefficient, loss making, inefficient. Inefficient. You go to B. So B, I hope you guys are able to see the current return of B. The current return of B, ladies and gentlemen, is 18. Is 18. Current return of B is 18 minus, in this case here, the CPFM return of boy, 17. Even if it's just one bob or 1%, it's profit making. So if it's profit making, we call them super efficient. We call them super efficient. Super efficient. Very good. Super efficient. Super efficient. So you go to cow. You go to cow. So cow, ladies and gentlemen, I can see the current returns of cow. I can see the current returns of cow, 14. So we have here 14 minus 12.2. Again, this is super efficient because it is what here? Profit generating. So this gives me 1.8, right? 1.8. 1.8. It is super efficient. Super efficient. It is super efficient. And then we have D, ladies and gentlemen. So D, what do we have here for D? I will take the current returns of dog. The current returns of dog, we have 8. Current returns of dog, we have 8. So 8 minus 10.4. This is Achilles' thing. This is inefficient. Eight minus 10.4 will give me what here, somebody? Minus 2 point. Those answers are now not coming as they were coming. Now the frequency started going down. So minus 2.4, right? So minus 2.4. So long as it's negative, it is inefficient. 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 And then we'll come and do the risk-free asset. So risk-free asset, I can see the current return there is 5 and the CPFM return is 5, which gives me 0. So 0 return, this automatically zero profit is break-even point. So break-even point, we simply say that the security is efficient. The security is efficient. The security is efficient. So if it's exactly 0, efficient. Profitable, super efficient. Loss-making, inefficient. Loss-making, inefficient. And my prayers are, ladies and gentlemen, that at our workplaces today, we shall be super efficient. Thank you so much and bye. See you tomorrow.